Welcome to our journey into the world of key performance indicators, KPIs, for small businesses. Did you know that 90% of small businesses fail due to poor financial management? That's a shocking statistic, but it highlights the importance of understanding your business's vital metrics. What if I told you that companies using advanced KPIs are 20% more likely to experience significant growth? Yes, it's true. These numbers aren't just random stats, they can make or break your business. We're going to dive deep into the KPIs that matter most and how to use them to boost your success. Stick with us to uncover these secrets. You'll gain insights that can transform your small business. Ready to unlock the potential of KPIs? Let's get started. Chapter 1: The Hidden Gem KPIs, Unearthing Unsung Metrics. Welcome to the first chapter on KPIs that every small business should monitor. Today, we're diving into the hidden gem KPIs. These are the ones that often fly under the radar but can make a huge difference in your business success. First up is Customer Lifetime Value, CLV. CLV measures the total revenue you can expect from a single customer over their lifetime. It's crucial because it helps you understand how much each customer is worth to your business. A study by Bain & Company found that increasing customer retention rates by 5% increases profits by 25% to 95%. Knowing your CLV helps you invest in long-term customer relationships. Next, let's talk about employee engagement scores. Engaged employees are more productive, creative, and committed. According to Gallup, companies with high employee engagement are 21% more profitable. Keeping track of how engaged your team is can directly impact your bottom line. Make sure to regularly survey your employees and act on their feedback. Another hidden gem is the innovation rate. This KPI measures the impact of new ideas and products. It's all about staying ahead of the competition. Did you know that 84% of executives say innovation is critical to their growth strategy? Keeping track of how many new products or services you launch and their success rate can guide your strategic planning. Monitoring these KPIs requires more than just tracking numbers. It's about understanding the stories they tell. For instance, if your CLV is low, it might be time to improve your customer service or product quality. If your employee engagement scores are down, consider implementing more team-building activities or recognition programs. Using tools like CRM software can help you track CLV effectively. Platforms like Salesforce or HubSpot provide detailed insights into customer behavior and lifetime value. For employee engagement, tools like SurveyMonkey or OfficeVibe can be invaluable. These tools provide real-time feedback and actionable insights. Innovation rate can be tracked by setting clear goals for new product launches and monitoring their performance. Use project management tools like Trello or Asana to keep your innovation projects on track. According to a McKinsey report, companies that foster innovation see 60% higher profit margins. Chapter 2: Real-Time Revenue Rockets. Boost your earnings on the fly. In this chapter, we're focusing on KPIs that can boost your revenue in real time. These metrics help you make quick adjustments to increase earnings and stay ahead of the curve. First on the list is the sales conversion rate. This KPI measures how many of your leads turn into paying customers. Did you know that the average conversion rate across industries is about 2.35%? But top-performing companies have conversion rates of 11.45% and higher. Improving your sales conversion rate can significantly boost your revenue. To increase your conversion rate, focus on your sales funnel. Identify where potential customers drop off and address those pain points. Use A/B testing to optimize your landing pages and calls to action. HubSpot found that companies using A/B testing see a 49% improvement in conversion rates. Next, let's talk about average transaction value, ATV. This KPI measures the average amount a customer spends per transaction. By increasing ATV, you can boost your revenue without acquiring new customers. One way to do this is through upselling and cross-selling. Amazon reports that 35% of its revenue comes from upselling and cross-selling techniques. Train your sales team to suggest complementary products or higher-end options. Another strategy is bundling products together. For example, if you run a coffee shop, offer a discount on a pastry with the purchase of a coffee. This encourages customers to spend more. Return on marketing investment, ROMI, is another crucial KPI. This measures the revenue generated from your marketing efforts. A survey by Nielsen found that companies with high ROMI see a 32% increase in revenue growth. To maximize ROMI, track which marketing channels are most effective. Use tools like Google Analytics to measure the performance of your campaigns. Focus on the channels that provide the highest return and cut back on the ones that don't. Email marketing, for example, has an average ROI of 42 to 1. That means for every dollar spent, you can expect an average return of $42. Investing in email marketing can be a game changer for your business. Chapter 3, Customer Connection Chronicles, KPIs that drive loyalty. Welcome to the third chapter where we delve into KPIs that enhance customer loyalty. These metrics are essential for building strong, lasting relationships with your customers. First, let's discuss the Net Promoter Score, NPS. NPS measures customer loyalty by asking a simple question. On a scale of 0 to 10, how likely are you to recommend our product to a friend? Those who score 9 or 10 are promoters, while scores of 0 to 6 are detractors. According to Bain & Company, companies with high NPS grow at more than twice the rate of their competitors. To improve your NPS, focus on customer service and product quality. Respond promptly to customer feedback and resolve issues quickly. Next, consider the customer retention rate. This KPI tracks the percentage of customers who return over a given period. Keeping existing customers is more cost-effective than acquiring new ones. According to Harvard Business Review, increasing retention rates by just 5% can boost profits by 25% to 95%. Implement loyalty programs and personalized marketing to keep customers coming back. Reward repeat purchases and make customers feel valued. Customer Satisfaction Score, CSAT, is another crucial KPI. CSAT measures how satisfied customers are with your products or services. It's typically gauged through surveys right after a purchase or interaction. A study by McKinsey found that improving customer satisfaction can lead to a 20% increase in revenue. To boost your CSAT, ensure your customer service team is well-trained and responsive. Provide multiple channels for support, such as chat, email, and phone. Let's talk strategies. For NPS, follow up with detractors to understand their issues. Use their feedback to make improvements. Promoters can be your brand advocates. Encourage them to share their positive experiences on social media. This can increase your brand's visibility and attract new customers. For customer retention rate, analyze why customers leave. Exit surveys can provide valuable insights. Address the common reasons for churn and implement changes. Personalized marketing, such as tailored emails based on past purchases, can also improve retention. Make your customers feel special and appreciated. Chapter 4, Operational Excellence, KPIs for Streamlined Success. In this chapter, we're focusing on KPIs that ensure operational efficiency and effectiveness. Streamlined operations can significantly improve your bottom line. First up is the inventory turnover ratio. This KPI measures how often your inventory is sold and replaced over a period. A high turnover rate indicates strong sales, while a low rate suggests overstocking or weak sales. According to the Retail Owners Institute, the average inventory turnover for retail is about 8. Inventory management is crucial. Overstocking ties up capital and can lead to obsolete stock. Understocking, on the other hand, can lead to missed sales. Use just-in-time (JIT) inventory systems to optimize stock levels. Order fulfillment cycle time is another key KPI. This measures the time taken from receiving an order to delivering it to the customer. Fast fulfillment enhances customer satisfaction. A study by Supply Chain Quarterly found that companies with efficient fulfillment processes see a 15% improvement in customer retention. To reduce cycle time, streamline your order processing and logistics. Use automation to handle repetitive tasks and reduce errors. First Contact Resolution, FCR, is a KPI that measures the percentage of customer issues resolved on the first contact. High FCR rates lead to higher customer satisfaction. According to a report by MetricNet, each 1% improvement in FCR results in a 1% improvement in customer satisfaction. Train your customer service team to resolve issues quickly and efficiently. Provide them with the tools and information they need to handle customer queries effectively. Let's talk strategies. For improving inventory turnover ratio, consider using inventory management software. Tools like QuickBooks and TradeGecko can provide real-time inventory tracking. Regularly review your stock levels and adjust your orders based on sales trends. Implementing JIT systems can also reduce excess inventory and improve cash flow. For order fulfillment cycle time, streamline your processes. Use warehouse management systems to optimize picking and packing. Implement automated order processing to reduce delays. Partner with reliable logistics providers to ensure timely deliveries. Monitor your fulfillment process and continuously look for ways to improve. Chapter 5. Financial Health Snapshots. KPIs for Sustainable Growth. Welcome to the 5th chapter, where we explore KPIs that offer a clear picture of your business's financial health. These metrics are essential for sustainable growth and stability. First up is the gross profit margin. This KPI measures the difference between sales and the cost of goods sold. It's a clear indicator of your business's profitability. According to Investopedia, a healthy gross profit margin for most industries ranges from 25% to 75%. To improve your gross profit margin, focus on cost control. Negotiate better deals with suppliers and optimize your production processes. Next, let's discuss operating cash flow. This KPI measures the cash generated by your business operations. Positive cash flow ensures you can meet your obligations and invest in growth. A study by SageWorks found that the average operating cash flow ratio for small businesses is 1.66. To enhance your operating cash flow, manage your receivables and payables efficiently. Encourage early payments by offering discounts and delay payments to suppliers when possible. The debt-to-equity ratio is another crucial KPI. It compares your company's total debt to its shareholder equity. A lower ratio indicates a healthier balance sheet. According to the Harvard Business Review, the average debt-to-equity ratio for small businesses is 1.3. To maintain a healthy ratio, avoid taking on too much debt. Focus on growing your equity through retained earnings and capital investments. Now, let's talk strategies. Improving your gross profit margin involves both increasing revenue and reducing costs. Consider pricing strategies like value-based pricing, which aligns your prices with the perceived value to the customer. Reduce waste in your production process by implementing lean manufacturing principles. This not only cuts costs but also improves quality. For operating cash flow, efficient cash flow management is key. Use cash flow forecasting tools to predict and plan for cash needs. Automate your invoicing and collections process to speed up receivables. Managing your payables strategically can also improve your cash position. For instance, take advantage of early payment discounts only if it benefits your cash flow. Chapter 6. The Future Forecast. Predictive KPIs for Strategic Planning. In this chapter, we're focusing on KPIs that help predict future performance and aid in strategic planning. These metrics are vital for staying ahead of the competition and ensuring long-term growth. First on the list is the sales pipeline value. This KPI measures the total value of potential sales in your pipeline. It helps forecast future revenue and plan your sales strategies. According to HubSpot, companies with well-managed sales pipelines achieve 28% higher revenue growth. To optimize your sales pipeline, track the progress of each deal and identify bottlenecks. Use CRM tools like Salesforce or HubSpot to manage your pipeline effectively. Next, let's discuss customer acquisition cost, CAC. This KPI measures the cost of acquiring a new customer. A lower CAC indicates more efficient marketing efforts. According to Forrester Research, the average CAC for small businesses is around $82. To reduce your CAC, focus on inbound marketing strategies. Content marketing, SEO, and social media can attract customers at a lower cost. HubSpot found that inbound marketing costs 61% less than outbound marketing. Churn rate is another essential KPI. It measures the percentage of customers who stop doing business with you over a period. A lower churn rate indicates better customer retention. According to Bain & Company, reducing churn by 5% can increase profits by 25% to 95%. To reduce churn, focus on improving customer satisfaction. Offer exceptional customer service and create loyalty programs to keep customers engaged. Now, let's dive into strategies. For sales pipeline value, ensure your sales team is well trained in closing deals. Use data to identify the most promising leads and allocate resources accordingly. Regularly review your sales pipeline to ensure it's aligned with your business goals. Implementing a structured sales process can also improve pipeline management. Reducing customer acquisition cost involves optimizing your marketing spend. Focus on high ROI marketing channels and eliminate low-performing ones. Use analytics to track the performance of your campaigns and adjust them based on data. Invest in content marketing to attract organic traffic and reduce reliance on paid ads. To lower churn rate, prioritize customer feedback. Use surveys and feedback forms to understand customer needs and pain points. Implement changes based on their feedback to improve your products or services. Providing exceptional customer support is crucial. Ensure your support team is well equipped to handle issues quickly and efficiently.